Meeting of the New York City Retirement Systems for September 20th, 2017. Let me just go over the schedule. We are scheduled to be here until 1 o'clock between the public session and executive session. Then we'll have lunch up here, and then the different boards will caucus on the 8th floor, and you'll adjourn from your caucus rooms, as is our standard practice at this point. Okay? So with that, we will ask the executive directors of each board to call the rolls for each board. Let's start with police. Kevin?
Good morning. Representing the PBA.
Joe Alejandro, designee for Patrick Lynch, Mubarak Abdul-Jabbar, and John Puglisi.
Dan Torelli, designee for Corey Grable.
DEA. Michael Paladino. SBA.
Gary DeRosa, designee for Ed Mullins, SBA.
LBA.
Lou Turco.
CEA.
Roy Richter.
Commissioner of Finance.
Antonio Rodriguez, designee for Commissioner Jiha.
Mayor's Office.
John Adler, designee for Mayor Bill de Blasio.
Comptroller.
John Dorsett, designee for Control Stringer.
And the Police Commissioner.
Stephanie Zenberg for Police Commissioner O'Neill, designee.
Thank you. Okay, let's move on to fire. Who's calling the roll?
I'll call
Doug?
John Adler,
Yep, present.
Susanna Vickers,
Here.
Antonio Rodriguez,
Here.
Yeah, please.
Gerald Fitzgerald,
Gerard Fitzgerald.
oh,
Here.
Leroy McGinnis,
Here.
Eddie Brown,
Gerard Fitzgerald for Eddie Brown. Gerard Fitzgerald for Eddie Brown.
John Kelty. No? Kelly. I'm sorry, my hey, we're going to tell you. All right.
It's going to be easy, Doug.
All right. Thomas Phelan,
Here.
Jack Kelty,
Here.
John Farina,
Here.
Paul Mannix.
James Lamonda, proxy for Paul Mannix.
We have a quorum.
Great, thank you very much, Doug. Let's move to teachers. Dad?
John Adler.
I'm here.
Thomas Brown.
Here.
David Kazansky.
Present.
Deborah Penny. Raymond Orlando.
Here.
Susanna Vickers.
Here.
We have a quorum, Mr. Chairman.
Thank you. And NICERS? Melanie? Yes, I'm here. Use your mic. Sorry.
David Jetter for Scott Stringer.
Okay. Public Advocate's Office.
Here.
Borough President Manhattan.
Present.
Borough President Brooklyn.
Present.
Borough President Bronx. Borough President Queens. Borough President Staten Island.
Present.
International Brotherhood of Teamsters.
Here.
Transport Workers Union.
Here.
District Council 37. Here. We have a quorum.
Thank you, Melanie. And BERS, Sandy Rich?
Mr. Adler, thank you. Mr. Orlando. Still there. Donald Nesbitt. Absent. John Mederich absent. Michael Kraft.
Here.
Thank you. Isaac Carmignani and Benjamin Shulden are absent. Mr. Chairman, we do not have a quorum, but we will administer these resolutions at our board meeting on the 27th of September.
Thank you very much, Mr. Rich. Okay, so we're in session, and Mr. Evans, I think it's your turn to do your performance reporting.
Thank you very much. We're going to start with a macro overview from Deputy CIO Mike Haddad.
Good morning. As usual, I'm going to start with an overview of returns in the second quarter. I'm going to attempt to put a narrative on these very positive returns despite the chaos in Washington. And then since the second quarter coincides with the end of the fiscal year, I'm going to do a slightly more deeper look into public asset class returns, and then conclude with current global macro issues. And within that, I'm going to do a deeper dive into what I call a potential regime shift in interest rates and why that matters to all of us. So usual slide to start, second quarter. I would draw your attention to the third column and just very, very strong returns for the quarter across all asset classes. So how do we resolve strong returns, which are usually coincidental with strong economies, with the chaos that goes on in D.C.? I would offer up three answers to that question. The first would be stronger earnings growth across U.S. developed markets and international equities. The Russell 3000 earnings in Q2 were 2% higher than Q1. Not a big swing, but it's the second consecutive quarter of an increase in earnings in the U.S., and that hasn't happened in a couple years. In EFI, earnings were up almost 10% in Q2 versus Q1, and in EM, almost 15%. Second factor for these positive returns is stronger and more balanced growth around the globe. Specifically Europe, the downside political risk has been largely eliminated due to positive election results. China, all their concerns about financial instability have seemed to have disappeared for the period of time. And by one thing that I read, 90% of emerging and developed economies are growing at or above trend. So that speaks to the breadth of growth across the globe. The third reason I would argue for these positive returns has been lower than expected inflation, continued global quantitative easing, specifically the ECB and the Bank of Japan, which has resulted in lower yields in the second quarter. So before I go into a little deeper dive into the fiscal year, any questions or comments on Q2?
So would you say that Russell 3000 earnings growth is more attributable to top line kind of revenue growth, or folks kind of keeping say wage inflation or kind of expenses in line?
I think both, and I think anytime you do a year over year, whatever, you have to go backwards. And I think a lot of the drop in earnings happened because of energy and mining. So with oil prices stabilizing, that decline has stopped. So it looks good, but the reality is it was terrible because of all that energy stuff. That would be my answer. So this is a different look into the U.S. equity market. This is the fiscal year ending June of 17. Top line, a reminder as to what the Russell 3000 returned. And then I showed a little more nuance into the different components of the equity market. And I would draw your attention to two things. First, the outperformance of small cap versus mid and large. And I would attribute that a lot of that happened post-election, and that is optimism on some kind of corporate tax reform, more focus on domestic sectors of the economy by the administration. The second part I would draw your attention to is the continued outperformance of growth over value. Another 4.5 percentage points, and that trend continues. Although it seems to be getting a little long in the tooth when we think about some of the PE multiples on the FANG stocks. International equities. I'm presenting this one a little bit differently, with the top box showing the highest returns of the countries with the two highest returns. The middle box shows the countries with the lowest returns, and then the last box shows the returns for the countries with the three largest weights. So two takeaways for me for this, and this is in the bottom returns. Only one country in EFI had a negative return in the fiscal year, and that speaks to the breadth that I was referencing earlier. The second one I would draw your attention to, and let me step back and explain how I presented things here. The second column shows the return in dollars. The third column shows the returns in the local currency. So we, as you heard from Miles in the summer, we currently are not hedging any of our currency risk. We are absorbing the currency risk. So when we think about our returns in foreign equities, it's the return of that market plus or minus the return of the currency versus the dollar. So I would draw your attention to Japan. In local currency, in yen, the Japanese market returned almost 30.5%. In dollars, that return comes down to 19% because yen depreciated versus the dollar during that during that fiscal year by almost 10%. So it just highlights, again, why we're so focused on it here and what should be the proper FX hedging policy for your portfolios. This slide is emerging market equities, same format as EFI. And again, I would draw your attention to the bottom two countries. you think about the volatility in emerging market equities, and over a whole fiscal year, those are the worst returns in Philippines and Qatar. It's pretty remarkable that that's the extent of the negative returns, and again, it speaks to the breadth of positive returns across the emerging market asset class. Then I draw your attention to first to China, the largest weight within emerging market, and the very, very strong returns in China in the fiscal year ending June of 17. And then I would draw your attention to Taiwan. So this is an example where the currency worked in our favor. In local returns, Taiwan returned 25%, but in dollar returns, it was 32%, almost 33%. And that's because the Taiwanese currency rallied against the dollar during that time period. So in this instance, being in dollars better served the investors in the Taiwanese market. So this slide speaks to our core fixed income portfolio. And a reminder, this is the components of treasuries, mortgages, and investment grade. And it's very unusual for this portfolio to have a negative return, because you think about the coupon income that results in any given year. But what I draw your attention to is the three different sleeves of the Treasury portfolio. The top row is short duration, intermediate duration, and long duration. And you can see the different returns, the worst return in long duration, and that is despite a yield curve flattening. And by that, what I mean is the front end went up in yield more than the back end went up in yield. Roughly speaking, the front end was up in yield by about 80 basis points, and the long end was up by about 55 basis points. But the riskiness of a basis point in the long end is 10 times the riskiness of the basis point in the front end, and thus you get returns skewed that direction. No.
I mean, so my question is about where is our duration?
Can't hear you, John.
I'm gonna cover that, John, when I go through my slides.
More nuanced look at high yield, and you can. The takeaway from here is the more riskier credit, triple C's outperform the higher credits, which you kind of would expect in a risk-on environment. Before I go to the current stuff, any questions or comments on the fiscal year ending 2017? So a lot of these bullet points are similar to what you've seen from me before. Let me just expand on a couple before I go into the interest rate discussion. So probability, timing, and specifics of U.S. tax and spending policy. Why does this matter? It matters a lot. If we get some kind of corporate tax cut, it's more likely to benefit stocks that have high tax rates versus stocks that have low tax rates, and that kind of speaks to more to small cap versus large cap. You think about the tax rate on some of the smaller companies, and they don't benefit from some of the shenanigans, if you will, that the larger companies do with domiciled outside of the country and tax arbitrage. It would also speak to U.S. probably outperforming international and EFI if we can get the corporate tax changed. So there's going to be some major shifts in capital flows if indeed something gets done there. Let me skip to the third on the change in the Fed chairperson. Chair Yellen's term expires in February of 18. The president, as of now, has not made a decision on whether he's going to reappoint her or someone else. So that's going to have a big influence on Fed behavior. The chair is the intellectual leader of the Fed and guides policy within the objectives of what the Fed is trying to accomplish. So who that person ends up being is going to be very important for interest rate policy going forward. Let me just for that dive into what I call a potential regime shift in interest rates and why it matters. So three components, as you can see on here: change in global QE, very, very, very low policy rates, and a budget deficit that's likely to increase both short-term and long-term. And let me address each one of these separately. So today, the Federal Reserve holds that's the day 2 of their meeting. Their results will be announced at 2 p.m. today. And what's widely expected by markets is no change in interest rates, but an announcement to begin balance sheet normalization. What does that mean? During the crisis, the Fed expanded their balance sheet from $800 billion to $4.2 trillion. They printed money to buy government bonds. The objective of that quantitative easing was to lower interest rates, drive asset prices higher, and then have a follow-through from asset prices into the economy. I think history will judge how successful it is, but as we stand here today, there's no doubt asset prices are higher. The impact on the economy, I think, is one that's more arguable. So why does the Fed need to why do they need to shrink their balance sheet? If they were to leave their balance sheet in place, we would have more stimulative monetary policy than we would otherwise. And given the current economic conditions, it's not called for. And the consequence, if we leave it, is to inflate asset prices. And when asset prices come down, it's going to be very destabilizing to the economy. So it's completely appropriate for them to do so. They've never done quantitative easing before. They've never done normalization before. So it's going to cause ripples in the market that we just don't have the ability to understand at this point. Specifically, what are they expected to announce today? The beginning of the balance sheet normalization in October. It's going to start at $10 billion a month. And it's going to stay that way per quarter, and it's going to increase each of the next 5 quarters till it gets to $50 billion a month. It's a lot. It's meaningful. What they aren't going to tell us today is what their goal of balance sheet normalization is. Most people think they're going to shrink down to $2.5 to $3.5 trillion, and even in this world of government, $1 trillion matters. So the second component is the ECB. So they're still doing quantitative easing. They're doing $60 billion a month, and financial conditions have improved dramatically in Europe. And there's not a need for the same level of accommodation. And secondly, they are just running out of bonds to buy. They allocate their purchases by what's called the capital key, and that's the component of the GDP of each of the countries to the overall European economy. So think Germany's the largest contributor. They buy more German bonds than anything else, and they're running out of German bonds to buy. If they were to change the capital key and buy more Italy and Spain, they could do that, but there's no appetite for that within the European Central Bank. This slide sums up well what I attempted to describe. There's a lot going on this slide, so let me take a shot at trying to explain it. On the y-axis, it's a measurement in dollars. The 1,000 is $1 trillion. Across the x-axis is the years, and within each year you see 4 different shaded colors, and each one of those colors represents a country. I'm sorry about the legend is so small, but the yellow color is the U.S., the dark blue is Japan, the light blue is Europe, and the green is UK. If the bar is above the 0 line, it's an increase in net issuance, and if it's below 0, it's a decrease in net issuance. And net issuance in this slide is defined as government bond issuance minus central bank purchases. So and the line graph is the sum of those 4 bars. So you can see in 2016 was the maximum impact of global quantitative easing of almost $500 billion of net negative issuance. Unprecedented. And what that means is the central banks were buying more than they were issuing, and thus causing interest rates to get so low. So look at the swing from 2016 to 17, almost to 0, so a $500 billion net swing. And then the one that's really alarming is going to 2018. So this projection is based on the expectations that I laid out with the Fed and the ECB, and the increase in issuance from the U.S. as our budget deficit is growing. And it's almost $1 trillion swing in net issuance in 2018 versus 2017. And my colleagues have heard me harp about this week after week in our investment committee meetings, and I get pushback like, it's well advertised, it's known, is it in the price? I would argue it's not in the price for a few different reasons. One, the Fed hasn't made the announcement yet. There's some uncertainty as what they will do. The ECB has not made their announcement yet, so there still remains uncertainty. And when you think about the plethora of global geopolitical events that are out there, if one of these things happens, the global QE reduction is going to change. You know, the policymakers will react to changes in the world. So when you do skews, there's got to be some probability that something bad happens in the Korea Peninsula and all this ends. So I don't think it's in the price, and I think it's going to result in higher interest rates. This slide speaks to how low policy rates are across the G4. The first line is the U.S. This slide goes back 30 years, and this is simply the Fed funds rate. So you can see in '08, the funds rate plunged down to almost zero in the midst of the crisis. It was held there for up until late 14. The Fed has raised rates 3 times, 25 basis points each, and we read in the financial press it's a big deal. But when you look at it historically, it's a ripple. And even with the funds rate at 1.25, by any measurement, it's still historically low. Same thing with the ECB. You've heard me talk about it. It's a negative rate. It's minus 0.40 basis points, and this doesn't have the same sense of history because, as you recall, the ECB and the euro came around in '99, so they've only had official rates since '99. But if you were to take that back and plug in the German rate, it would look very similar to what the U.S. one did. So again, historically low. It's never been negative before, and I would argue it doesn't belong there in the current economic environment. UK, similar story, different magnitude. And the last one is the Bank of Japan. They are slightly negative as well. They've been there since the turn of the century. Again, historically low rate. And my last point about potential regime shift in interest rates is the U.S. budget deficit. So the graph on the right shows both actual on the left side of it and projected on the right side. And the projections are not including any change in tax policy or infrastructure spending, so anything that this administration might put through. What's baked into those numbers is more of the increase in spending on Medicare and Social Security, and just the way that math works, unless there's some reform to them, our deficits are going to get a lot worse over time. Why does that matter? It means more issuance by the government to pay for it, and it also, when you put money in the hands of someone else, it results in economic growth. So that would argue for an increase in interest rates of some magnitude going forward. Why does it matter? Simply.
5 years ago, almost 5 years ago, 43 New Yorkers, including public servants that you all represent, lost their lives to Hurricane Sandy. And we are here because your investors continue to fund climate chaos. Climate chaos where people are losing their lives. We were going to sit here peacefully, but we were not allowed to bring in our people to represent New Yorkers. We are here because we cannot continue to ignore the climate chaos that is happening all over our country. We hope that you all take the right side of history and divest from companies that are willfully lying to the public about climate science. Please do the right thing. Stand on the right side of history.
I'm so confused.
I guess they weren't interested in market implications of higher interest rates. So very simply, higher yields is going to impact all valuations of our fixed income portfolio. That's just a given, and it gets much more complex than that. Corporate bonds trade as a spread off of government bonds, and typically when yields rise, spreads widen as well. So I would expect a larger impact on the credit part of our portfolio. Secondly, when you're in a rising rate environment, PE multiples historically contract. So that's going to impact our equity portfolio, and private equity trades at some multiple plus or minus what public equities do. So it's going to impact our private equity, both what our managers buy and when they sell things as well. And lastly, given the massive amount of unknowns as to what's going to happen, I would argue volatility is going to increase across all asset classes. Volatility is at all-time lows across all asset classes, and when you introduce more interest rate volatility, it's going to cause volatility to go up across the other asset classes. And just by the way, capital pricing models work. When you increase volatility, it's going to have impact on all asset classes. So it's something that we spend a lot of time on investment committee thinking about the probability of rising interest rates, what measures we could or should take, and whether we're at a tipping point or not. And my argument is that we're at a tipping point given what the Fed is expected to announce today, the ECB is expected to announce in October, and also just the growth around the globe relative to where monetary policy is set around the globe. So let me pause there for any questions or comments on markets, not fossil fuels?
Question? Patricia Stryker, NYSER's trustee. The Congress is making rumbles about reducing taxes. So given that this could really happen, how will this also impact? I know you touched on it, but could you elaborate a little bit more on that?
If the reduction is in corporate taxes, I would expect it to be positive for earnings for businesses. Just the simple math of lower taxes would argue for that. I think it would impact companies with higher tax rates more than lower tax rates. If you think about Apple, who has an effective tax rate of, I don't know what it is, somewhere between 5 and 10%, it's not going to lower their tax rate. If you think about a domestic company, a small manufacturer who's paying the full freight, it's going to help them more. How we fund or don't fund the tax cut is extraordinarily important. If it's in, what's the word, budget, yeah, but what is it called if they sunset it in 10 years? Yeah, reconciliation. If it's a reconciliation bill, it goes away in 10 years, and the CBO doesn't score it against the increase of the deficit. It's not scored that way. So that means we're going to have a worsening deficit for 10 years. They sunset in 10 years, and they'll put it off for the future. That's an increase in the deficit any way you cut it, however the CBO scores it, more issuance, so higher interest rates. If you're talking about an increase in individual tax rates, there's a lot of complexity in that. It's, what rates do they drop? How much do they drop them? How do we fund it? And I don't think there's a lot of clarity on that. There's discussions they're going to fund it through eliminating deductibility of state and local tax, and there's going to be a lot of pushback in a lot of states regarding that. My own 2 cents is I see higher probability of a corporate tax cut than I do of meaningful changes in the individual tax rates. But again, what we all read in the paper this morning is this is unfunded. So it's an increase in the deficit, higher interest rates, and all those implications.
Antonio Rodriguez, not all of them. Just so, with regard to, if the kind of the overall market implications of rising interest rates, on the one hand, we think about, kind of valuations, but on the other hand, we also have kind of the liability side. Net, do you think that if asset prices aren't as inflated on the one hand, and so that goes across our entire, investment portfolio, but on the other hand, low interest rates are bad generally for pension fund liabilities. Net, do you feel that this is overall we should be welcoming kind of the end of QE around the world, and kind of the reduction of the balance sheet from the Fed?
I see Scott lean forward. I'm going to defer.
The positive effect from the present value of our liabilities going down will probably overwhelm the negative effect of asset prices decreasing. It depends on the exact difference, but we have a longer duration of our liabilities than we do of our assets, and even if they were equal, that would be the case. But because our assets are less than our liabilities, it would have an even more pronounced effect. So it should improve the funding ratio, other things being equal.
And I would add also, when we, public pension accounting, when we discount our liabilities, we discount them over our actuarial rate of return, not the market rate. So it's not going to change the NPV of how.
Yeah, I'm sorry, Mike is right in terms of the accounting, because I was giving you an economic answer, but in terms of the fact that the discount rate of the liabilities won't change, that's absolutely right, and that's how I should have answered. I was giving you an economic answer. Yeah.
Thank you, Mr. Adler. Ray Orlando, Board of Education and Teachers. I'm a little confused by the volatility expectation, I guess. If the directional nature of the interest rate change is obvious, where does the volatility come in, I guess? It seems relatively predictable.
It's the interplay between balance sheet normalization and how much they increase interest rates at the same time. Or do they? Does one substitute for another? The Fed has tried to make their plan very, very clear. I think they've done that. The two unknowns are when they start. I think we'll know that at 2 today. We don't know where they're going to end. So there's volatility within how much they're going to do. Depending on what markets and the economy do, they may or may not raise rates at the same time. So that interplay between the two of them is the unknown. The ECB, we don't exactly know what's going to happen there. A policy rate of minus 40 basis points, is just historically, it's never been negative before. Can they move it forward? What are the implications for, core Europe versus Southern Europe? They're very different. How the currency market moves, how the euro specifically moves is very important to the ECB. So as that moves up, they're likely to do less because stronger currency is bad for the economy. So that introduces volatility into it as well. And given where volatility levels are, I don't have the graphs on display for you. I'm happy to forward them to you. They're just shockingly low. They look like the policy rates. It's kind of up here, then they've plunged down and they remain there. So someone who's toiled in this stuff for 30 years, it just sticks out as an anomaly to me.
Any other questions for Mike? Okay, Mike, thanks very much.
Okay. So now we're going to talk about how we did in this environment that Mike's been talking about. And, the bottom line of what he was saying is that we have lived in very good times over the past year. And there are many reasons that we should be cautious that these good times will last. And he went through that at the end. But let's take a look at how we did. First of all, to raise a question, the volatility in the equity markets, and this is all the markets, has been shockingly low. We're usually in high single digits. Is what we model. To be down in the 3% range is just unbelievably low and abnormal. So to some extent, as you're returning to normalized rates and less central bank interference, you would just expect to return to normal. Mm-hmm. We had a good quarter, up 3 to 3.5%. I want to focus also on the fiscal year. It's the second column from the left. And you can see, remember that we have a 7% rate of return assumption. We almost doubled that. We were at 13% across the systems, ranging from a little over 12.7 up to 15.3, depending on the system. So the 13% on average compares favorably with what we would have gotten if we just indexed the money, 65.35, we would have gotten 12%. And if we compare, it's 100%, 100 basis points better. And if we compare it to the average large institutional portfolio, we also did better. You need to take 25 basis points off that 12.9 to have a like-for-like comparison, because we show you net of fees returns. Let's turn now to the mix of our portfolio or asset allocation. As you know, we've been implementing your asset allocation over the last number of months, and it's almost in place. We're a little overweight international equities and some domestic equities over on the left, the big bubbles. If you look all the way over, second panel from the right, you can see high yield. We're still very much underweight high yield. We warned you about this couple meetings ago, and you approved a temporary placeholder because we did not think we would get to the high yield allocation anytime soon. We're still doing a manager search in high yield, and so we can see that placeholder. You hadn't voted for it yet on 6:30, but you can see it a little bit if you look all the way to the right with convertible bonds, which is one of the placeholder assets that's being held instead for high yield. You can see it a bit in bank loans when we're a little overweight, the middle panel, particularly in teachers. And as you can see, on an inflation-protected basis, other than the bank loans, we are right on track with the long-term asset allocation. In deflation protection, we have, at the snapshot at 6:30, we had a little extra credit. We've sold that down to target levels now. But we still have some extra credit also being held for high yield. So when you look at that placeholder cocktail that you voted for this summer, it represents most of the overweights and underweights that we have. We are underweight treasuries a little bit, and we're beginning to bring the treasuries up, and we're beginning to increase the duration. John asked about the duration while Mike was talking, so I'll show you this slide which shows the duration of the treasury portfolio. We talked to you in March. The duration was at the green bubbles, and at the end of June, we were at the gray bubbles, a little bit higher, right on track with the long-term program that we put together. We promised you we'd be right here at the end of June, and we'll continue on the plan that we had outlined. The ultimate targets are in blue, with teachers, police, and fire wanting to have larger durations in the Treasury portfolio. It's dicey to be adding to duration right now for all the reasons that Mike mentioned. And these long-duration assets have the most sensitivity to changes in interest rates. That's good if interest rates go down. It's bad if interest rates go up. We're holding these for defense. So in some ways, we would prefer it if we don't do well with the Treasury securities. They only really do well when there's a lot of worry out there and our other asset classes are underperforming. But we will continue to put the defense in place as we've discussed. When you look at the overall portfolio,
Scott, just a question on
Yes,
that.
sir.
So can you remind us when are you targeting being full on the long duration?
I'd prefer to make forward-looking statements about large movements of capital in the executive session, if you don't mind.
Sure.
Because we do have the cameras on. So. If we look at, I'm happy to come back to that right as soon as we go into executive session, John. When you look at the portfolio, left panel is the portfolio. The blue line is our assumed rate of return. Middle panel is the benchmark. Both the portfolio and the benchmark well above the assumed rate of return. And you can see in the right panel the excess. I'll blow up the excess for you here. Now it's on the left. And then break it down between asset allocation in the middle and manager value added on the right. Modestly positive year. A little bit more than modestly positive in the case of BRRRR. Across all systems, we're pretty flat on asset allocation. That's pretty much what we expect over time. There is one thing that's going on in there that I should highlight. Because we had a lower than target duration in treasuries, and because treasuries were very negatively affected by the increase in rates, we actually made money from an asset allocation perspective in the Treasury portfolio. It was offset by a lot of other things, very dispersed, but we did have that impact in terms of asset allocation. When you look at the total portfolio, again, this is just the same slide on the left, you can see that it was a better year than we'd had for the last 3 years. We've been struggling for our managers to add value relative to indexing. All told this year, we did add 100 basis points to the portfolio, but over the 3 years, we're still a little bit underwater except for BRRRR. Okay, oops, this is one too many. I'm going to start with equities. Equities is a tough place to make money actively. We've struggled with this as others have struggled for many, many years. We're modestly negative on a 3-year trailing basis. Net of fees, we're more or less flat this year with only BRRRRs and teachers just slightly being positive. On average, I think we're about 40 basis points under. I'm going to do something that I haven't done before, but since it's the fiscal end of year, I'm going to dive into the managers to show you where this is coming from, which managers have been strong and weak. And we can talk specifically about the managers in the executive session, particularly anything forward-looking. This is a new slide, and let me take just a moment to go through it. You have in the left column the mandate, small cap core in the top panel, whether it's active or quant mandate, and then the manager, who in the case of the top is Wellington. They outperform their benchmark. They're only in NYSERS. They outperform their benchmark by 178 basis points. And so in green is anyone that outperformed. In red is anyone that underperformed. And I've got all the active mandates in U.S. We run mostly index money in the U.S., so we don't have many managers. So just going through them quickly, Iridian, which is the second line, they run a narrow portfolio. Their performance is very episodic. They went through a big rethinking of their portfolio structure about a year ago and narrowed the portfolio further. It seems to be working. There are no particular sectors or cap sizes that have outperformed. Wellington, on the other hand, fundamental stock picker, benefited from strong results in IT and healthcare and finance. And these are the three sectors that Mike mentioned that led the market. They were overweight in these sectors, and that helped them. Interestingly, one of the reasons IT in particular was so strong this year was the FANG stocks, Facebook, Amazon, Netflix, and Google. They're just this giant levitation, this giant movement, and Wellington was able to outperform without those stocks. They're a little bit more value than that. Brown Asset Management, a typical growth manager in the small growth side, very strong results, and you would expect them to have strong results in a growth-led market that's led by IT and healthcare. That's their specialty, and they sort of live or die by those sectors, and it was a good time, and they did good stock picking in them as well as being overweight. So if we look on the soft side, the first is held narrowly just by police. It's DFA. They underperformed a little bit. It should say quant next to DFA. They're really not an active manager. In value, deep value really outperformed. These are companies with low earnings that are very cyclical and so forth. And this is what DFA specializes in. So you would have thought that the DFA would have outperformed, and so we looked into that. And deep value did help them, but that was more than offset by the fact that they had a small cap tilt, which is, DFA is small and value. That's the way they lean, and the small cap tilt them. Hurt them. Small cap tilt hurt them. Also, being underweight healthcare hurt DFA. The next three are two different quant managers, VTL, RAFI, both small and large, and they were really hurt by the dynamics of the market. These guys, rather than weighting their indexes, these are quant algorithms. They don't weigh them by market cap. They weigh them by price to book, by sales, by fundamental factors, and they're going to be out of stocks like the FANG stocks that just take over and get huge weights and are trading at really outsized multiples. So by design, they're going to underperform in a market like this. We're not terribly worried about it, but it was a weak period for them. We have added to our positions. We have a smart beta search coming up, so we'll talk about these guys in depth. Ceradex and Dalton Griner are quality value players. For instance, Ceradex won't own a stock that doesn't pay a dividend. And so when the deep value, junky value stocks were leading and the quality value stocks were behind, they're out of phase, and they got hammered this period relative to the market. Keep in mind, these are all relative to the markets that they're in. Their absolute returns are actually all pretty decent, but we judge them on how they do versus their benchmarks. So that's a new slide. I hope it's helpful. I'm going to go through it again. You guys will give me some feedback afterwards as to whether this is you like this extra detail. But I want to show you what's going on under the hood a little bit. So back to the top down. As we struggled in domestic, international has worked very well, and it's worked very well for a long time. International equities has been a good place to have active managers. We have very strong active managers, and this year was no exception. If you dive into the details on it, you can see that not everybody outperformed their benchmark, but some of them had kind of career years. Bailey Gifford is a perfect example. This is a growth manager who outperformed in a strong growth environment. They held a lot of healthcare and tech names. Plus, they got lucky in that there were some corporate actions, one major acquisition of a large holding, and several spin-outs that worked very well. So everything was going right for Bailey Gifford. Very strong year, and their long-term results are strong as well. But like a lot of active managers, very episodic, and you sort of have to buy them when they're out of phase and lighten up when they're going really strong to make money on them long term, or just hold them through thick and thin. Generation also producing very, very strong results. I won't go into the details other than to say they too were very overweight healthcare and IT. Acadian is a different kind of quant algorithm. They build their algorithm based on investor behavior, and so that it ends up getting a large tilt towards sectors and towards countries, and they were very overweight technology names, even technology-related names that are not in the tech sector, healthcare technology, consumer companies that have technology, and that worked extremely well for them, both here and in their emerging market mandate that you're going to see in a second. Let's see. In terms of the negative guys, Spruce Grove and Causeway, quality value in a deep value market. I mentioned that in the U.S. Also being hurt by being underweight financials. So really in this market, if you didn't have excellent stock picking, you had to be overweight IT, healthcare, and financials. And if you were largely underweight any of those, it was going to cost you. And these guys got bit by that tilt. Pyramus is a stock selection story. You really can't categorize anything that they're doing other than to say that they get bit by some bad stock selection in consumer staples earlier in the year. They made up for it partially as the year wore on, but it was an off period for Pyramus. Move now to emerging markets. Same story for Acadian, the quant guys with the behavioral bias. But interestingly, here it's having a pronounced market impact. They were very overweight India, Brazil, and Korea, which helped them tremendously. DFA, with this algorithm, and now we're in the emerging markets, benefiting from deep value, and so against a different benchmark with a different portfolio that's even more heavily tilted towards deep value, they did very well. Bailey Gifford, much like their developed mandate, doing very well with a growth bias and a healthcare tilt. Parametric was the lone one that was really building character during the quarter in emerging markets. This is a quant algorithm that has specific country weightings. They were in all the wrong places. So they were underweight all the top markets, China, Korea, Taiwan, and they were overweight the Philippines, which as Mike said, was one of the only countries that actually had negative performance during the year. So they were unhappy campers, and we were as well with those results. So we look at, I'm going to pull the altitude up a little bit because it's not quite as interesting, although we like the results. Very strong year for investment grade on a relative basis. All 7 managers convincingly outperforming the investment grade credit index. This was particularly helpful because we were, as you remember, lightening up on our investment grade portfolio. So selling into strength, particularly with some of our more illiquid strategies. Very, very helpful. We're now down to the targeted amount, and this area, which is not always the easiest to transact in, happened without a hitch. We'll go now to high yield, which on average was pretty dull, just about break even, a little better than that. We've struggled a bit over the past 3 years. We're doing a search, so we'll get a chance to look at some new high yield managers and look at this carefully. We're in the midst of the search now. One thing I can say of interest is that Loomis, who's our opportunistic manager, outperformed the others that are mostly core and defensive strategies. And there was a pretty big spread. Like Loomis was 200 basis points above the benchmark for the fiscal year. Bank loans is interesting. We underperformed by design. And so all of our managers are pretty defensive in bank loans, and bank loans is in the defense part of the portfolio where we're protecting against inflation. We're not trying to be very aggressive in structuring the portfolio. So all 6 managers underperformed, mostly because of their defensive nature and a tendency to lag in markets like this. 3-year numbers are good. They're still positive, and so we're largely satisfied with the managers as we go forward. ETI, the comparison with the benchmark is driven by the duration. ETI has our ETI portfolio has a much larger duration than the benchmark does. So as Mike mentioned, the short end of the curve was up 50, the long end of the curve up, 80, the long end of the curve up 55. Which meant that anything with a longer duration was going to get hammered, and that in fact happened with our ETI portfolio. We get same underwriting standards. These loans are all guaranteed, and there's nothing wrong with the ETI program. But it's going to show like this when rates are going up. And if Mike's cautions are right and rates really begin to rise, expect the ETI to underperform its benchmark, which has a shorter duration. Hedge funds. Hedge funds had an 8.5% return on average, 2% volatility, little or no correlation to the public equity markets. This is just what the hedge fund portfolio is supposed to do. We have it just in police and fire. It's doing its job, and it's a very, very valuable component to the overall portfolio. Modestly positive results sort of disguise the fact that the direct portfolio is up 100 basis points versus the benchmark, which is another 100 basis points over the HFRI index. Our fund of funds manager, Pramal, actually underperformed by 300 basis points during the year. So there's a 400 basis point spread between the two of them. Luckily, Pramal is the minority of the portfolio at this point, and but this has been a continuing trend. Overall, we're very happy with the hedge fund results for the year. I'm going to turn now pretty quickly to private market data. Remember, I'm going to switch from time-weighted return to dollar-weighted return, because the managers decide when they take money in and out. So it's appropriate to to view them on an IRR or a dollar-weighted basis. Private equity, we're not happy with these results. I mean, they started to look like they're getting a little better. We're now basically a break-even versus the Russell 3000. We want to get 300 basis points over to make up for the illiquidity that we're taking on in the leverage, and we're not getting. And so we've been asking ourselves a lot of questions about the portfolio, really looked into it. And it's frustrating because we narrowed the underwriting to 20 primary managers, 40 emerging managers, and that group of managers has been doing really well. If you look at the IRR on that, it's 500 basis points above the benchmark, well above our 300 basis point target. So since 2010, we've been giving money to people that have been outperforming by 500 basis points. Our runoff portfolio, which we decided not to give any money to these people pretty much across the board, has underperformed by about 400 basis points. So there's a 900 basis point swing. And you would hope that, starting in 2010, everything would switch. And we did an analysis, which we will show you in depth when we go through the annual plan for the private equity, that shows the percentage of the drawdown each year and where it's coming from. And interestingly, because there's such a huge lag and because you cannot turn off once you've committed to a manager, those runoff portfolios dominated the investments in 2011, 2012, 2013, and only recently have we gotten to the point where the new investments in any vintage are dominated by the primary portfolio. 2017 vintage, for instance, is going to be 90% primary managers and only 10% runoff managers. But that's had a much slower time frame in terms of working its way in. It was compounded by the fact that right before we changed the underwriting standards, we put a lot of contributions into these runoff managers. And so, there's a big push in 2006, 2007. So that laid a pretty difficult environment to bring these numbers up. But we're going to start watching the vintages very closely. We'll show you vintage-based numbers, and we should look for, if we continue to get the kinds of spreads that we've gotten, we should see the recent vintages really beginning to pop up. Okay, that's private equity. OFI is a younger asset class. We have big ambitions there. We've done well relative to, if we'd put the money in high yield and leveraged loans, which is our benchmark here, but not the 300 basis points we're shooting for. We're hoping that in a sort of perverse way, you get a more difficult environment, tougher environment for credits, and our OFI managers will really be at their best doing distressed work, dealing with complicated structures, and they'll be able to really differentiate themselves. Real estate, there's some shades of PE here. This is the core portfolio, and it is impacted hugely by a major push that was made in 2006, 2007 to put money into core open-end funds. And relative to the index, the core open-end funds have done okay. We're now looking very closely at them. But the real problem was that was the peak of the cycle. And so, we've had uneven investments in this asset class over time. And the last thing you want to do is be putting more money in at the top of the cycle, which is exactly what happened. We've been much more balanced in recent years in how much money we're putting to work. And if you look, and you'll see this when Yvonne comes through with her annual plan, the recent numbers, even the past 5 years on a time-weighted basis, are above benchmark. So, the results that we've been doing going forward have been decent in core, and they've been even better in non-core. Here, our primary managers are all, there are 10 primary managers, they're all producing positive returns relative to the public market equivalent. The difference in the systems here has to do with the mix that you had of runoff managers versus primary managers. And otherwise, the primary managers in non-core have been very consistent, and we've been re-upping with a number of managers that have delivered strong results over a number of years. I have one great slide to show in the private area, and I'm going to give you some cautious tone about it. When you look at these numbers, are great. 600-700 basis points above the benchmark. But when you break it out, you realize that there was one deal in one fund that just shot the lights out. It was in the First Reserve Fund, which is one of the first funds in our I think it's 2013 in our infrastructure program. And they bought a pipeline, energy pipeline, and we turned around a couple months later and sold that energy pipeline for 3 times what we bought it. And so when you look at the overall energy part of the infrastructure portfolio, which is a small part of the portfolio, the IRR is 70%, right? So that's why these numbers are so high. But even when you take that out, when you look at the rest of the portfolio, the IRR is 10%, which is well above our benchmark of core plus, CPI plus 400 basis points, and above the PME benchmark as well. So we've got decent results even without that. But that push that we got from that sale inflated the numbers and will become less and less important as we move forward. So we love to have that. I just don't want you to think that we can always beat the benchmark by 700 basis points. But Petya will certainly try. She's done a great job. I'm ready to take any questions that you have before we move to executive session. And I will, again, caution that any forward-looking questions, let's leave for the executive session.
Questions for Scott?
Okay, that concludes our comments for the general session.
Okay, I think unless there's anything else for public session, we'll accept motions to move into executive session. Okay. Call for the question. Let's start again with fire. Is there a motion from the fire board to enter executive session? Identify yourselves for our transcriptionist.
John Kelly, so moved.
Doug White.
Second. Okay, motion made and seconded. Any discussion? All in favor of the motion to move into executive session at the fire board, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Okay, motion carries. Next, we have police. Is there a motion at the police board to move into executive session?
Motion to go into executive session.
Who are you?
Joe Alejandro.
Second.
Who are you?
John Dorset, Controls Officer.
Thank you. Motion made and seconded. Any discussion? All in favor of the motion at the police board to move into executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Okay, motion carries. Teachers, is there a motion at the teachers board?
So moved.
David, who are you?
I think I'm David Kazansky.
Is there a second?
Second, Susanna Vickers.
Thank you. Motion made and seconded. Any discussion? All in favor of the motion to move into executive session at teachers, please say aye. All opposed, please say nay. Any abstentions? Okay, motion carries. And at NYSERS, is there a motion to move into executive session? Who are you?
Mr. Chair, I'm here. Angelina Martinez, Queensborough President's Office.
For the record, the Queensborough President is here. Second, is there a second?
Second, Umair Khan for the Public Advocate.
Thank you. Is there any discussion? All in favor of moving into executive session at the NYSERS board, please say aye. Aye. All opposed, please say nay. Any abstentions? Okay, motion carries at NYSERS. I think that does it because BRR's not an official meeting. Okay, so we're now in executive.
All right, so at this time, Nicole, if you'd like to give us a report out.
Sure. During the executive session, the trustees heard recommendations from the Bureau of Asset Management and its consultants to reach the following decisions. The trustees proceeded with a public equity implementation plan, placed certain managers in a pool of equity index investment management service firms for potential exposure, details to be made public at the appropriate time, hired 2 U.S. equity index managers, details to be made public at the appropriate time, to proceed with an infrastructure implementation plan, hired a manager in the asset class of opportunistic fixed income, details to be made public at the appropriate time, and lastly, to approve a redemption from a hedge fund, details to be made public at the appropriate time.
So at this time, I'd like to make a motion to adjourn.
Second.
Thank you.
Took action to proceed with a public equity implementation plan, the details of which will be posted at a later date. The board also accepted the recommendation to establish a pool of equity index investment management service firms for potential use. The details of those will be disclosed upon contracting. The board agreed to hire an equity index manager. The details of which will be contracting. To also hire a non-U.S. equity manager, the details of which will be disclosed on contract. The board also approved an infrastructure implementation plan and agreed to hire an opportunistic fixed income manager.
Great. Thank you very much. I think that concludes our business for today. Thank you for the motion to adjourn. Is there a second? Motion Motion made and seconded. Any discussion? All in favor of the motion to adjourn, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. Meeting is adjourned.
Certainly. Two implementation plans were presented, consensus was reached, which will be announced at the appropriate time. Two manager presentations were received, consensus was reached, which will be announced at the appropriate time. Several managers were added to a pool for potential future use. One OFI manager was presented and discussed, consensus was reached, which will be announced at the appropriate time. And one watch list item. Yes.
So with that, I believe we are done with public session unless there's any other business. Now I believe a motion to adjourn public session is in order. So moved. Second. All in favor?
Aye.
We are adjourned.
Anybody else?
Session of the meeting.
So moved.
Is there second? Any objections? Hearing none, motion carries. During the executive session, the board discussed various investment matters, reviewed personnel decisions, and made certain decisions about which candidates to hire. Now we need a motion to adjourn.
So moved. Second.
Any objections? Hearing none, motion carries. We are now adjourned.